All right, welcome to Hungry for Moat. We had to take a little bit of break, and now we are back. We're still covering the Buffett partnership letters for the year 1965. The first one, we are not covering. This is not the Berkshire Hathaway letter. This Buffett is going to be overlapping now. He's still writing his partnership letters, and he's not taking more an active role in Berkshire Hathaway. So let's see what he's going to be doing with his partnership. And this is the first half of of the year. And his financial year is January to December, which makes it easy. All right, and this is written in July, covers January through June. During the first half of 1965, the Dow Jones Industrial Average declined from 874 to 868. This minor change was accomplished in a decidedly non-Euclidean manner. The Dow instead took the scenic route, reaching a high of 939 on May 14th. Adding back dividends on the Dow of $13.49 gives an overall gain to ownership of the Dow for the first half of about $7.39, about 0.8%. We had one of our better periods with an overall gain before allocation to the general partner of 10.4%. Oh wow, that's pretty good.
Oh, wow.
Over a 9.6 percentage point advantage over the Dow. To bring the record up to date, the following summarizes the year-by-year performance of the Dow, the performance of the partnership before allocation to the general partner, and the limited partner's result. Okay, so here we have a table that kind of goes over the Dow, the partnership, and ultimately what you got if you were an investor and Buffett took his little commission. Clearly, in the first half of 1965, the partnership dominated the index, and in 1960, and let's just jump to the compounding here because we know they've been dominating every year.
Yep.
I mean, it's ridiculous how the Dow has done actually pretty well. The Dow has compounded 10% annually in those past 10 years, and Buffett has done about 27. Wow, 27%.
Incredible.
And as an investor, you're 22%. That's incredible.
Yeah.
Okay.
So a quick question about that. The partnership results, right? So does that mean he gets 5% of the I guess how much ever he outperforms? Does he get to keep the 5%?
Yeah, that's his
Okay.
profit because he's the only general partner.
But so really the stakeholders or the shareholders get 22%, but really his real performance is 27%.
Correct. Right.
Okay.
And it's not as well. I mean, his partnership only kicks in after he's made like about 6% or so.
Yep.
And then he takes partial ownership of the profit, and so the more money he makes, the more he personally makes.
Yep. Makes sense.
Our constant admonitions have been the short-term results less than 3 years have little meaning, particularly in reference to an investment operation such as ours that may devote a portion of resources to control situations, and that our results relative to the Dow and other common stock or media usually will be better in declining markets and may well have a difficult time just matching such media in very strong markets. With the latter point in mind, it may be imagined that we struggled during the first 4 months of the half to stay even with the Dow, and then opened up our margin and declined in May and June. Just the opposite occurred. We actually achieved a wide margin during the upswing and then fell at a rate fully equal to the Dow during the market decline. I don't mention this because I'm proud of this performance. On the contrary, I would prefer it if we had achieved our gain in a hypothesized manner. Rather, I mention it for 2 reasons. You are always entitled to know when I'm wrong as well as right, and it demonstrates that although we deal with probabilities and expectations, the actual results can deviate substantially from such expectations, particularly on a short-term basis. As mentioned in the most recent annual letter, our long-term goal is to achieve a 10 percentage point per annum advantage over the Dow. Our advantage of 9.6 points achieved during the first 6 months must be regarded as substantial above average. The fortitude demonstrated by our partners in tolerating such favorable variations is commendable. We shall most certainly encounter periods when the variations are in the other direction. During the first half, a series of purchases resulted in acquisition of controlling interest in one of the situations described in the General Private Owner section of the last annual letter. When such a controlling interest acquired, the asset and the earning power of the business become the immediate predominant factors in value. When a small minority interest in a company is held, earning power and assets are, of course, very important. But, excuse me, they represent an indirect influence on value, which in the short run may or may not dominate the factors bearing on supply and demand, which results in price. When a controlling interest is held, we own a business rather than a stock, and a business valuation is appropriate. We have carried our controlling position at a conservative valuation mid-year and will re-evaluate it in terms of assets and earning power at year-end. The annual letter is issued in January 1966. Will carry a full story on this current control situation. At this time, it is enough to say that we are delighted with both the acquisition cost and business operation, and even happier about the people we have managing the business. Interesting. So we have to make a note of the next letter that we're going to be reading so that we can learn about this company. Do you have any thoughts on this?
No. Yeah. No, nothing.
I mean, there's nothing much. Just kind of teasing the reader a lot.
Yeah.
Okay, investment companies. We regularly compare our results with the two largest open-ended mutual funds. They follow a policy of being typically 95 to 100% invested in common stocks. And the two largest closed-end investment companies, these four are Massachusetts Investor Trust, Investor Stock Fund, Tricontinental Layman, manage over $4 billion and are probably typical of most of the $30 billion investment company industry. Their results are shown in the following table. My opinion is that this performance repels that of the majority of the other investments advisory organizations which handle and aggregate vastly greater sums. Alright, that's crazy how the aggregate of the investment company here is about $4 billion or $30 billion.
Yeah.
I think that's like probably how much, I don't know what, like one investment company probably, like such as
Lehman or something.
Sequoia or like SoftBank, they probably control huge sums of money themselves. And Vanguard probably has, I don't know, probably has more than $1 trillion, I would think, at this point.
Mm-hmm. Yeah, it's pretty interesting. And you know what's crazy is that it doesn't seem like these. I mean, really, it's very counterintuitive because most of the people have these larger fund managers have so much money, but they're still giving extremely crappy returns. It's so weird. It's almost the opposite of what really should happen, where you just leave everything in the Dow and you'll be fine. But anyway, yeah. Or if you were lucky enough to invest with Buffett, which would be priced out of anyway, but the Dow is still open to the public. Yeah.
Yep.
Interesting. So 10.5. Oh, if you go back just a little bit. So 10.5 was the average. If you go down a little bit.
Yeah.
Go down.
Sorry.
Yeah, so 10.5 is the annual compounded rate. So it really, over a course of maybe 10 years or so, the Dow did outperform everything else except for Buffett partnership. So really, doubling down on that previous comment I had about Dow being the second best maybe thing that we could do compared to what Buffett did. Yeah.
Last year I mentioned that the performance of these companies in some ways resembles the activity of a duck sitting on a pond. When the market rises, the duck rises. When it falls, back goes the duck. The water level was virtually unchanged during the first half of 1965. The ducks, as you can see from the table, are still sitting on the pond. As I mentioned earlier in the letter, the ebb of the tide in May and June also substantially affected us. Nevertheless, the fact we had flapped our wings a few times in the preceding 4 months enabled us to gain a little altitude on the rest of the flock. Utilizing a somewhat more restrained lexicon, James Lowry, director of the University of Chicago's Center of Research and Security Prices, was quoted in May of 1955 Wall Street Journal as saying, "There is no evidence that mutual funds select stock better than by the random method." Wow. Of course, the beauty of the American economic scene has been that random results have been pretty darn good results. The water level has been rising. In our opinion, the probabilities are that over a long period of time it will continue to rise, though certainly not without important interruptions. It will be our policy, however, to endeavor to swim strongly with or against the tide. If our performance declines to a level you can achieve by floating on your back, we will turn in our suits. Again, in summary, more rhetoric about just that Buffett's doing this because everybody's making money, this market is up, and if he can continue to beat the market, then he'll just shut down his operation. Advance payments and advance withdrawals. We accept advance payments from partners and prospective partners at 6% interest when they are received until the end of the year. While there is no obligation to convert such advance payment to a partnership interest at the end of the year, this should be the intent at the time it is paid to us. Similarly, we allowed partners to withdraw up to 20% of their partnership account prior to the year end and charge them 6% from the date of withdrawal until year end when it is charged against their capital account. Again, it is not intended that partners use this like a bank, but that they use the withdrawal right for a truly expected need for funds. Predictably, needs for funds such as quarterly federal tax payments should be handled by the beginning of the year reduction capital rather than through advance withdrawals from Buffett Partnership Limited during the year. The withdrawal privilege is to provide for the unanticipated. The willingness to borrow through advance payments and lend through advance withdrawals at the same 6% here may sound downright un-Buffett-like. You can be sure it doesn't start my adrenaline flowing. Certainly, such a no-spread arbitrage is devoid of the commercial overtones an observer might impute to the purportance of our transactions. Nevertheless, we think it makes sense and is in the best interest of all partners. It's pretty cool, yeah. It's like, I'm not really making any money on the spread. I mean, I'll take money from you 6%, I'll give you 6%, or if you want money early, I'll charge 6%. And I think because he doesn't want to betray his bank. He just wants to create these so people don't freak out and just pull their money, that they have a lifeline, and if they want to invest, they can, they're not sitting on lots of cash getting nervous, that they can just build this habit of like, here's some money, Buffett, just invest it.
Yeah. So it's going to have full trust, I guess, because I remember of a story where Buffett said that, there was this guy who was, storming into the office and saying, hey, look, I need my money and all this stuff, or like, I think what you're doing is maybe the wrong thing, whatever it might be, just this conflict with Buffett. And after that meeting, he's like, hey, just pay that guy out. I don't want that headache. Really, I think what Buffett is doing here is just asking for people to leave him alone so that he can do what he does best, which is invest. So really, he doesn't want to be bothered.
He's buying peace of mind.
Right.
A partner who has a large investment in indirect ownership of a group of liquid assets should have some liquidity present in his partnership interest other than at year end. As a practical matter, we are reasonably certain that advance withdrawals will be far more than covered by advance payments. For example, on June 30, 1965, we had $98,000 of advance withdrawals and $652,000 of advance payments. Wow. People are just gushing money in there.
Yeah.
Like, yeah, wow. It reminds me of the Fry's theme, Fry theme was like, shut up and take money. Why then the willingness to pay 6% for the net of advance payments over advance withdrawals when we can borrow from commercial banks at potentially lower rates? The answer is that we expect on a long-term basis to earn better than 6%. The general partner's allocation is 0 unless we do. Although it is largely a matter of chance whether we achieve the 6% figure in any short period. Moreover, I can adopt a different attitude regarding the investment of money that can be expected to soon be a part of our equity capital than I can on short-term borrowed money. The advance payments have the added advantage to us of spreading the investment of new money over the year rather than having it hit us all at once in January. On the other hand, 6% is more than can be obtained in short-term dollar secure investments by our partners. So I consider it mutually profitable.
Yeah.
So clearly 6% is more than they're getting in the bank. So if they're going to put some money in the bank, they'd rather just give it to Buffett, and it sounds like he likes the liquidity.
Yeah, and the 6% isn't that bad. I mean, if you think about it, you'd be getting on average 9 to 11%, but the upside is way higher for the people who believe in Buffett because he's really outperformed the market way more than.
But the question is, why can't, if Buffett likes the 6% of that money that he has to pay interest on, why not just borrow at less money that at less interest rate than from the bank directly? But I think most of this money he doesn't have to pay back.
Yeah.
It gets converted into equity, so he just likes that kind of setup.
And also, even if you borrow from the bank, you can't expect when the stock market will go down, right? So if there's a crash, then you're still in debt for that money that you have to pay back, but not the case.
Here it turns into basically a partnership where he doesn't have to.
Yeah.
Okay. The mold expansion program to 909.25 square feet described in the annual letter was carried out without a hitch. The Pepsi's never even got warm. He's still into Pepsi. He doesn't learn about cocaine. John Harden joined us in April and is continuing the record whereby all the actions in the personal field have been winning ones. As in past years, we will have a letter out about November 1st to partners and those who have inducted an interest in me by the time in becoming partners, with a commitment letter for 1966, estimate of 1965 tax situation, etc. All right. I think we can probably skip this one.
Okay. Well, can you go back a little bit? What was this one about?
This is all about
just the accounting of.
Yeah.
Okay.
You're gonna be getting tax documents.
The ground rules. Yeah. There's a fantastic
more
book.
About
Shout out
it's more about his partnership structure than actual investing.
Yeah, I agree. And actually, there's a book called The Ground Rules of Buffett. That's a pretty good book, just about his structure of how he manages money for his partners. It's a pretty good book. Yeah. Shout out.
Should we just jump to the next one?
Yeah.
Continue everything in one?
Yeah.
All right. So here we go. This is basically the second half of this theme here. So we're going to get 2 in 1 here. Written in January 20th, 1966. There we go. Our war in poverty was successful in 1965. Specifically, we were about $12 million less poor at the end of the year.
Let's see, maybe something to say about that. I'm not
Last
sure.
year, under a section in the annual letter entitled Our Goal, please particularly note it was not headed Our Promise. I stated we were trying to achieve an average advantage relative to the Dow of 10 percentage points per annum for BPL before allocation to general partners, again with the large amplitudes and the margin from perhaps 10 percentage points worse than the Dow in a bad year to 25% point better when everything clicks. My fallibility as a forecaster was clearly demonstrated when the first year fell outside my parameters. We achieved our widest margin over the Dow in the history of BPL with an overall gain of 47%.
Wow.
Compared to an overall gain, including dividends, which would have been received through ownership of the Dow, 14% for the Dow. Naturally, no writer likes to be publicly humiliated by such a mistake. It is unlikely to be repeated. Oh, I'm sorry, I was wrong. I think I am amazing.
And he's like, I just wanted to do 10 points better, but guess what?
I feel humiliated. Please don't punish me.
Ooh, here's the partnership.
That is juicy. He's really breaking his own record. Here's the summary. Just gonna jump to the summary, and clearly it's the same format. So Dow, like 14%. Juicy.
Insane.
And if you're the partner, as these go ridiculous, look at the differential. I mean, Buffett is taking 10%, more than 11%, probably 10% off the top. But you get 37%. That's called passive investing.
Yeah, that's beautiful.
Doing nothing.
But I'm wondering, I still maybe don't understand his fee structure here. I thought it was 6% on top of whatever you get, he gets to keep.
No. Simple, super simple.
Mm-hmm.
He's managing your money, and he's going to get you 6% at least. And after 6%, I think it's like 0.25%. So if you get 7% total return, he gives you 6, and of the extra 1%, he takes a quarter.
Okay, a quarter of every percent.
On top of 6%. I think that's what it is. So like 36, about 40. Let's say it was 46%.
Mm-hmm.
So 46% would mean about 40 percentage points out of 6. So of 40, he would take a quarter of that, so 10. Mm-hmm. So he took about 10.
Gotcha. Yep, understood.
And here's your annual compounded. Man, it's those 30% compounded. I mean, that is
beautiful.
That is incredible.
Yeah.
30%. I mean, that's your doubling rate of 3 years. Not even. Less than 3 years.
Yeah. Yeah.
26 would have been 3 years. Wow.
Incredible, man. Yeah, and over how long? 57 to 67 almost, so about 10 years. Wow. Incredible.
And Dow is giving you 11%. I mean, if you're not doing any work, you can't really cry. But
yeah,
he's not really working with small monies anymore, small sums.
Mm-hmm.
And if you're doing nothing, you're still getting 23%.
Mm-hmm.
Oh my God. After last year, the question naturally arises: what did we do for an encore? And a disadvantage of this business is that it does not possess momentum to any significant degree. If General Motors accounts for 54% of domestic new car registrations in 1965, it is pretty safe to bet that they are going to come fairly close to that figure in 1966 due to owner loyalty, dealer capabilities, productive capacity, consumer image, etc. Not so for BPL. We start from scratch each year with everything valued at market when the gun goes up. Partners in 1966, new or old, benefit to only a very limited extent from the efforts of 1964 and 1965. The success of past methods and ideas does not transfer forward to future ones. Wow. Each year starts from scratch. I continue to hope on a longer range basis for the short sort of achievement outlined in the article section of last year's letter, copy so available. However, those who believe 1965 results can be achieved with any frequency are probably attending weekly meetings of the Halley's Comet Observers Club.
As in, it'll only happen once in every.
Yeah.
Yeah.
weekly meetings on the U.S. Conservative Club. That's it. Damn, this dose of deep. We are going to have losses years, and are going to have years. I agree with Dow, no doubt about it. But I continue to believe we can achieve average performance for the Dow in the future. If my expectation regarding this should change, you will hear it immediately.
Even though he says this, that's never been true for the past 10 years.
That's the thing. That's why these people just, listen to their guidance, but their guidance is always negative, and you're like, what? Should I invest? Like, sure. I'm invested, but guess what? I'm a sad because look at me. I've made all this money so far. I for sure can't continue it because look at all the statistics. Like, nobody can continue it.
Yeah, it's this fine line between confidence and hubris, I guess. But I don't understand. I mean, it's hard for you to not be confident if you're killing it for the past 10 years. I don't see how you can skate to the other side of
somebody
confidence. I don't know.
who continues to kill it and continues to be super humble and negative about it. If he can continue to do it, I mean, that person is going to be great.
Yeah.
Like, the opposite would be Bitcoin. You're continuing to do money like year after year, doing great, and you're like, yeah, man, it's the future. You can only go up to the moon, bro.
Yeah. And then in 10 years, you never see that guy. Yeah.
Yeah, they'll be in jail or it's gone.
Interesting.
Investment companies, we regularly compare our results with the two largest open investment companies, mutual funds that follow the policy of being typically 95. So just complaining again. At least before mutual funds manage about $5 billion in the industry of about $35 billion now.
Mm-hmm.
My opinion is that their results roughly parallel with the overwhelming majority of other investment advisory organizations which handle and aggregate vastly greater sums. The purpose of this tabulation solution of the Dow is no pushover. Dow is amazing. Dow, buy the index. And let's see. Here you go. All of them. There's Dow. There's a limited partner. It doesn't even have a general partner. Just Dow, limited partner, all winners.
Mm-hmm.
So the Dow, the limited partner. I mean, these are all the years.
Let's see the
obviously these
table.
are all this positive. Dow has negative years, but never Buffett. Buffett is allergic to negative years.
Yeah, let's see the compounded table. My God, still incredible.
Beautiful. The number. I mean, honestly, this is a really good business model. Just create a fund, charge like 2% fee, and just buy the Dow under all of it, and just keep the cash.
and then beat everyone else out of the blue. Yeah, you're absolutely right.
No, but you will make so much money. Like, it's so simple.
Yeah.
And then you're down to like, well, yeah, the market was low. What can you do?
Yeah.
It's beautiful.
It's beautiful, and probably better for the shareholders if the only index you had was the S&P 500.
But it is the most guaranteed way that you will make money. Like, this guarantees that you running this fund will make money because the fees are not conditional on performance.
Yep.
So if you really want to make money, open a fund and charge, asset management fees.
Yeah.
Efficiently.
So smart.
A number of the largest investment advisory operations, managing in some cases well into billions of dollars, also manage investment companies partly as a convenience for smaller clients and partly as public showcase. The results of these funds roughly parallel those of both funds on which we report. I strongly believe in measurement. The investment managers mentioned above utilize measurement constantly in their activities. They constantly study changes in market shares, profit margin, return on capital, etc. Their entire decision-making process geared to the measurement of management, industries, comparative yields, etc. I am sure they keep score on their new business efforts as well as the profitability of their advisory operation. What then can be more fundamental than the measurement and return of investment ideas and decisions? I certainly do not believe the standards I utilize and wish my partners to utilize in measuring my performance are the applicable ones for all money managers, but I certainly do believe anyone engaged in the management of money should have a standard of measurement, and that both he and the party whose money is managed should have a clear understanding why it is an appropriate standard, what time period should be utilized, etc. Frank Block put it in very well in the November-December 1965 issue of the Financial Analyst Journal. Speaking of measurement of investment performance, he said, however, the fact is that literature suffers a yawning hiatus in this subject. If investment management organizations sought always the best performance, there would be nothing unique in careful measurement of investment results. It does not matter that the consumer has failed to ask for a formal presentation of the results. Pride alone should be sufficient to demand that each of us determine objectively the quality of his recommendations. This can hardly be done without precise knowledge of the outcome. Once this knowledge is in hand, it should be possible to extend the analysis to some point at which partners of weakness and strength begin to assert themselves. We criticize a corporate management for failure to use the best of tools to keep it aware of the progress of a complicated industrial organization. We can hardly be excused for failure to provide ourselves with equal tools to show the efficiency of our own efforts to handle other people's money. Thus, it is our duty to report that systems of performance measurement are not automatically included in data processing programs of most investment management organizations. The sad fact is that some seem to prefer not to know how well or poorly they are doing. Wow. Damn, he just like this the whole industry in the most polite manner.
I know, but it's a pretty good lesson on like our own individual portfolios. Like it's so easy. I think Guy Spears said the same thing, where he says, it's easier to distort yourself into thinking that you put in a lot of money into a certain stock, and so you're very confident in that thing. But really, it should be considered your whole net worth. How much of it are you really putting? So really, you need a measuring stick, as Buffett like reemphasizes in all these letters. You need something to say, how are you doing? How well or bad are you doing? And if you don't have that measuring stick, like he compares himself to the Dow every year. And so maybe that's a good lesson to take away for us, where we have to say, hey, look, we have to be honest with ourselves. Last year I did worse than the Dow, and next year I'm doing worse than the Dow, and the year after I'm doing worse than the Dow. Okay, I don't know what I'm doing here. Let's just go and just put all my money in the Dow and just let it ride it out. Or maybe the opposite, where you clearly do better than the Dow, but at least you have a measuring stick to compare yourself against, because you might think you're doing great even though you're losing a lot of money.
Damn. Yeah, I think that's probably, even for retail investors, I think that's a good idea, like, because it kind of tells you what is your opportunity cost of trying to,
Yeah.
I do disagree. Like, I think maybe Buffett's amazing. Like, he's trying to measure his performance on a year-to-year basis. I do think, like, if you're trying to do this on your own, you do need, like, maybe a 5-year period. I would say if you haven't, nothing has, you continue to lose after 5 years, you should probably just index everything.
Mm-hmm.
But I think just having one poor year or 3 poor year back to back in a super bull market, that is is bull because of access, the stupid access. That's okay. I mean, if you're missing out, if you don't want to participate. But the caveat is, how are you measuring? I mean, if you continue to measure the traditional PE as a way of like what is the price of earning ratio, or is a stock going up or not? That may not be the best way to measure. Just because you have now internet companies that they have real value, but PE is not going to tell you anything about their real value. And then I mean, that's probably a good example, but then you also have again, I'll use internet companies that not profitable. They're still bad business. They're not building those network effects. They're burning cash, but because they're big shot internet companies, well funded by VCs that wanted to IPO, that the stocks just goes up and up when it IPOs just because of sheer access, you know. So you want to avoid both of those things and try to value things. And I think after having said and done everything, I think just following an index is a pretty good measuring stick. It's uncomplicated, it's measurable, and there's a lot of wisdom in the index.
Yeah, I agree. And maybe, I don't know if I completely agree about like not measuring yourself every year, because that means you don't have a diversified portfolio. Because that means you're too much into one thing where there's a huge dip and you see more opportunity in that sector. But really, you're trying to beat the S&P 500 every year. That's how compounding would work. So even if you'd got like 10 years down the line, you made a 10x, but you really need to um, measure it for those 10 years against the Dow. You know what I mean? Like I almost feel
I
as
see
though
what you mean, but
like
I
yearly.
don't think that is true. I mean, you should measure yourself every year, but I wouldn't make big changes just because you had one down year.
Yeah.
Yeah.
But it is good, like lessons learned type of thing. Maybe
Yeah, just
you
more
want.
data, and then
Yeah,
at least because if you're not measuring, then you don't even know.
yeah, that's
Unless
right.
you'll be on alert
That's right.
if you're,
Yeah.
Okay, frankly, I have several selfish reasons for insisting that we apply a yardstick and that we both utilize the same yardstick. Naturally, I get a kicking out of beating par. In the lyrical words of Casey Stengel, show me a good loser and I'll show you a loser.
Okay.
More importantly,
I just got it
I
too.
ensure that I will not get blamed for the wrong reason having losing years, but only for the right reasons doing poorer than down. Knowing partners will grade me on the right basis helps me do a better job. Finally, setting up the relevant yardsticks ahead of time ensures that we will all get out of this business if results become mediocre or worse. It means that the past successes cannot cloud judgment of current results. It should reduce chance of ingenious rationalization of inept performance. Bad lighting has been bothering me at the bridge table lately. While this masochistic,
Masochistic approach.
masochistic approach to measurement may not sound like much of an advantage, I can assure you from my observation of business from entities that such valuation would have accomplished a great deal in many investment and industrial organizations. So actually, he's talking about basically like lean and like the Six Sigmas and process improvements, quality improvements. Like this is a big part of a lot of corporate culture. At least they try to continue improvement internally.
Mm-hmm.
And about you need to measure what's your outcomes, and you need to take steps, identify why you are not where you should be and how you can get there, and then try it and then repeat. And he's basically saying the same thing. Like you can't really beat anything unless you can measure it, and you need to figure out what you're going to measure, what makes sense. And if you're not really measuring anything and you continue to say you're going to do a good job of one thing without measuring your results, then what the heck are you doing? Like how can you say you're doing a good job when there's no measurement?
Yeah.
That's shared with everybody.
Yeah.
Even if not shared with anybody, nobody's asking for it. At least internally, you should know. So if you are evaluating others or yourself in the investment field, think out some standards, apply them, interpret them. If you do not feel our standard, a minimum of 3-year test versus Dow, is an applicable one, you should not be in the partnership. If you do feel it is applicable, you should be able to take the minus years with equanimity in industrial regions as well as cerebral regions, as long as we are surpassing the results of the Dow. And he's preaching about this on his best year.
Yeah, yeah, it's pretty incredible. No gloating here. Wow.
The sorrows of compounding. Usually at this point in my letter, I have paused to modestly attempt to set straight the historical errors of the last 400 or 500 years. While it might seem difficult to accomplish this in only a few paragraphs a year, I feel I have done my share to reshape world opinion on Columbus, Isabel Francis, Peter Minuit, and Manhattan Indians. A byproduct of this endeavor has been to demonstrate the overwhelming power of compound interest. To ensure reader attention, I have entitled these essays The Joys of Compounding. What? He has essays like that? The sharp-eyed may notice a slight change this year. A decent rate, better we have an indecent rate of compound, plus the addition of substantial new money, has brought our beginning capital this year to $43 million. Several times in the past, I have raised the question that the increasing amount of capital would harm our investment performance. Each year I've answered negatively and presumed that if my opinion changes, I would probably report it. I do not feel that increased capital has hurt our operation to date. As a matter of fact, I believe that we have done somewhat better during the past few years with the capital we have had in the partnership than we would have done if we had been working with a substantially smaller amount. This was due to the partly fortuitous development of several investments that were just the right size for us, big enough to be significant and small enough to handle. And I feel that we are much closer to the point where increased size may prove disadvantageous. I don't want to ascribe too much precision to that statement since there are many variables involved, but maybe the optimum size under some market and business circumstances can be substantially more or less than optimum under other circumstances. There have been a few times in the past when, on a very short-term basis, I have felt it would have been advantageous to be smaller, but substantially more times when the converse was true. Nevertheless, as circumstances presently appear, I feel substantially greater size is more likely to harm future results than to help them. This might not be true for my own personal results, but it is likely to be true for your results. Therefore, unless it appears that circumstances have changed under some conditions, added capital would improve results. Or unless new partners can bring some asset to the partnership other than simple capital, I intend to admit no additional partners to BPL.
Wow. Maybe because he's thinking about switching over to Berkshire?
Perhaps. But he would disclose that. I mean, he's running that as well. Well, let's see. The only way to make this effective is to apply it across the board, and I've notified Susie that if we have any more children, it is up to her to find some other partnerships for them.
Wow, even his own children.
Oh, God. Because I anticipate that withdrawals for taxes, among other reasons, may well approach additions by present partners, and also because I visualize the curve of expectable performance sloping only very mildly as capital increases. I presently see no reason why we should restrict capital additions by existing partners. Damn, it's creating a cult. The medically oriented probably will interpret this entire notion as conclusive evidence that an effective AntiThird Bill has been developed.
I don't know if I get that analogy there, but maybe he's just saying he doesn't want something to get bigger. He just wants to contain it, and if partners
Well,
feel like
high
they want to go
thyroid
with it.
can make you go super fast and super strong and super, so it's gonna be like,
Ah,
oh, he's taking a chill pill now, what's going on?
interesting. Okay.
Trends in our business. Last year, I discussed our various categories of investments, knowing the penalties for cruel and unusual punishments. I will skip a rehash of the characteristics of each category, but merely refer you to the last year's letter. However, a few words should be said to bring you up to date on various segments of the business, and perhaps to give you a better insight into the strengths and weaknesses. The workout business has become very spasmodic. We were able to employ an average only about $6 million during the year in the workout section, and this involved only a very limited number of situations. And although we earned about 1.4 million, or about 23%, an average capital employed, this is calculated on an all equity basis minus borrowed money is appropriate in most workout situations. And we utilize it, which improves our rate of return above this percent. Over half of this was earned from one situation. I think it unlikely that a really interesting rate of return can be earned consistently on large sums of money in the business under present condition. Nevertheless, we will continue to try to remain alert for the occasional important opportunity, and probably will continue to utilize a few of the smaller opportunities where we like the probabilities. The General's private owner basis category was very good to us in 1965. So basically, spin-offs didn't do well, and now I'm talking about the Generals. Opportunities in this era have become more scarce with the rising Dow, but when they come along, they are often quite significant. I mentioned at the start of last year that we were the largest shareholder of three companies in this category. Our largest year-end 1964 investment in this category was disposed of in 1965 pursuant to a tender offer, resulting in a realized gain of for about $3 million. At year-end, 1964 had unrealized appreciation in this investment of about $500,000. Therefore, the economic gain attributable to 1965 for this transaction was only about $2.7 million, even though the entire tax effect fell on that year. I mentioned these figures to illustrate how our realized gain for tax purposes in any year bears no necessary relationship to our economic gain. The fundamental concept underlying the General's private owner category is demonstrated by the above case. A private owner was quite willing, and in our opinion, quite wise to pay a price for control of the business, which isolated stock buyers were not willing to pay for very small fractions of the business. This has been a quite common condition in the securities markets over many years. And although purchases in this category work out satisfactory in terms of just general stock market behavior, there are occasional dramatic profit due to corporate actions such as the ones above. So it sounds like he bought a lot of stock in a company, and then it kind of blew up, and then someone wanted to buy Buffett out. So Buffett sold his to some private equity. The control section of our business received. Oh wow, this is going to be interesting. Woo! The control section of our business received a transfer member from our private owner category. Shares in Berkshire Hathaway, ta-da!
Yeah.
Have been acquired since November 1962 on much the same line of reasoning as prevailed in security mentioned above. In the case of Berkshire, however, we ended up purchasing enough stock to assume a controlling position ourselves rather than the more usual case of either selling our stock in the market or to another single buyer. Our purchase of Berkshire started at a price of about $7.60 per share in 1962. This price precisely reflected large losses incurred by the prior management in closing some of the mills and made obsolete our changing conditions within the textile business, which the old management had been quite slow to recognize. In the post-war period, the company had slid downhill a considerable distance, having hit a peak in 1948 when about $30 million was earned before tax, and about 11,000 workers were employed. This reflected output from 11 mills. At the time we acquired control in spring of 1965, Berkshire was down to 2 mills and about 2,300 employees. It was a very surprised to find that the remaining units had excellent management personnel, and we had not had to bring a single man from outside into the operation. In relation to our beginning acquisition cost, in relation to our beginning acquisition cost of about $7.60 per share, the average cost, however, was about $14.86 per share, reflecting very heavy purchases in early 1965. The company on December 31st, 1965 had net working capital alone before placing any value on the plants and equipment of about $19 per share. Okay, so this is a good summary of his thoughts on Berkshire up to this point. I mean, he bought it at $7. I'm summarizing these two paragraphs, and obviously he recognizes this is a decline. He thinks management really has not been doing a good job, and he took a big control. He's skipping over the part that he got cheated and he was emotional after his dad's death, and he was trying to sell the shares, but they were nickel and diming, and then he ended up buying the business, just kind of like out of spite almost. He's not mentioning any of that. And then looks like they have raised money and they've been buying a lot of things and tried to revitalize the operation, and hence the share price has gone up, has more than doubled, almost tripled.
Well, I think he's saying it's about $19 a share, but when he bought it, it was $7.60, right?
Yeah, so it's down triple basically until now.
This is interesting. Berkshire is a delight to own.
There is no question that the state of the textile industry is the dominant factor in determining the earning power of the business. But we are most fortunate to have Ken Chase running the business in a first-class manner, and we also have several of the best salespeople in the business heading up this and of their respective divisions. While Berkshire is hardly going to be as profitable as Xerox, Fairchild Camera, or National Video in the hyper-intense market, it's very comfortable, able sort of thing to own. As my West Coast philosopher says, it is well to have a diet consisting of oatmeal as well as cream puffs. Wait, is that Charlie Munger?
No. I thought it was Munger too, but he's in LA, I guess. I don't know if
that's
probably
met.
Yeah.
Yeah, they probably have met.
Yeah.
Because of our controlling interest, our investment in Berkshire is valued for our audit as a business, not as a marketable security. If Berkshire advances $5 per share in the market, it does BPO. No good. Our holdings are not going to be sold. Similarly, if it goes down $5 per share, it is not meaningful to us. The value of our holding is determined directly by the value of the business. I received no divine inspiration in the valuation of our holding. Maybe the owner of 3 Wonder stocks mentioned above do receive such a message in respect to their holdings. I feel I would need something at least that reliable to sleep well at present prices. I attempt to apply a conservative valuation based upon my knowledge of assets, earning power, industry conditions, competitive position, etc. We would not be a seller of our holding at such a figure, but neither would we be a seller of the other items in our portfolio at year-end valuation. Otherwise, we would have already sold. Our final category is generals relatively undervalued. This category has been growing in relative importance as opportunities in the other categories become less frequent. Frankly, operating in this field is somewhat more ethereal than operating in the other three industries, and I'm just not an ethereal sort. Therefore, I feel accomplished here. Accomplishments here are less solid and perhaps less meaningful for future projections than in other categories. Nevertheless, our results in 1965 were quite good in the relatively undervalued group, partly due to the implementation of the technique referred to in the last year's letter, which served to reduce risk and potential augment gains. It should reduce risk in any year, and it definitely augmented the gains in 1965. It is necessary to point out that the results in this category were greatly affected for the better by only 2 investments. Candor also demands I point out that during 1965 we had our worst single investment experience in the history of BPL on one idea in this group. Damn.
I wonder what that is.
Overall, we had more than our share of good breaks in 1965. We did not have a great liquid quantity of ideas, but the quality, with the one important exception mentioned above, was very good, and circumstances developed which accelerated the timetable in several. I do not have a great flood of good ideas as I go into 1966, although again I believe I have at least several potentially good ideas of substantial size. Much depends on whether market conditions are favorable for obtaining a large position. All in all, however, we should recognize that more came out of the pipeline at 65 than went in. Okay, how big is it? So I'm just gonna.
3.
What, 3.5 pages now? You wanna read it?
Sure.
Alright, let's go.
Diversification?
Mm-hmm.
Okay, diversification. Last year, in commenting on the inability of the overwhelming majority of investment managers to achieve performance superior to that of pure chance, I ascribed it primarily to the product of 1. Group decisions, my perhaps jaundiced view, jaundiced view is that it's close to impossible for outstanding investment management to come from a group of any size, with all parties really participating in decisions. So this is kind of that theory of, too many cooks will spoil the broth type of thing.
Exactly.
Number 2, a desire to confirm to the policies and to an extent, the portfolios of other well-organized organizations. So this is, again, internal policies of the company or management firms. Number 3, an institutional framework whereby average is safe and the personal rewards for independent action are in no way commensurate with the general risk attracted to such action. Make sense? Number 4, an adherence to certain diversification practices which are irrational. And finally, and importantly, number 5, inertia. Okay, not doing anything. Very important. This year in the material which went out in November, I specifically called your attention to a new ground rule reading number 7. We diversify substantially less than more investment operations. We might invest up to 40% of our net worth in a single security under conditions coupling an extremely high profitability that our facts and reasoning are correct, with a very low probability that anything could drastically change the underlying value of the investment. We are observing, following a policy regarding diversification which differs markedly from that of practically all public investment operations. Frankly, there's nothing I would like better than to have 50 different investment opportunities, all of which have a mathematical expectation. This term reflects the range of all possible relative performances, including negative ones, adjusted for the probability of each. No yawning, please. So having a mathematical expectation of achieving performances surpassing the Dow by, say, 15% points per annum. If the 50 individual expectations were not intercorrelated, what happens to one is associated with what happens to the other. I could put 2% of our capital into each one and sit back with a very high degree of certainty that our overall results could be very close to such a 15% point advantage. It doesn't work that way. Yeah. It'd be great if you could diversify and still be sitting back and relax. It doesn't work that way. We have to work extremely hard to find just a very few attractive investment situations. Such a situation, by definition, is one where my expectation, defined above, of performance is at least 10% points per annum superior to the Dow. Among the few we do find, the expectations vary substantially. The question always is, how much do I put in number one, ranked by expectation of relative performance, and how much do I put in number 8? This depends on the great degree of the wideness of the spread between the mathematical expectation of number 1 versus number 8. It also depends upon the probability that number 1 should turn in a really poor relative performance. Two securities could have equal mathematical expectations, but one might have 0.05% or 0.05 chance of performing 15 percentage points or more worse than the Dow, and the second might have only a 0.01 chance of such performance. The wider range of expectation in the first case reduces the desirability of heavy concentration in it. Wow, this is so beautiful.
This is incredible.
This is incredible, yeah. So really, he's saying, you're going to have a lot of decisions to make. You can't just sit back and relax while, you just diversify and hope that you get better gains than the Dow. You have to be active. That's the first thing I got out of it. The second thing is, how do you decide between the investment number 1 or investment number 8? You have to compare against what the overall market might do. What are the chances that outperforming the Dow on investment number 1 compared to your second investment? What are the chances that even if the returns for both companies are exactly the same, what are the chances that one will get disrupted more compared to the other? So really, the margin of safety should be very confident in one investment compared to the other. That's how I read it.
But he's also saying, like, if you have, like, your number 1 best should be where you don't lose money. Yeah. He's saying if you have an idea which has really high growth potential and a 5% chance of losing money below the Dow, and then you have a second one that only has 1% chance of losing money below the Dow, but the upside is not as crazy good as the first one, he'd rather put money in the second one.
Yeah.
So he's not so, but it's about capital allocation, and then he's trying to limit his downside, but still have a good upside.
Yeah.
His biggest ideas tend to be the most certain ones, and
yeah.
They will be profitable.
Yeah, that's really beautiful, because it's almost as if, we all struggle with this, which is opportunity cost. Where should I put my money? And this is a kind of nice framework to think about it, where you can say, maybe the one which is which might have the same growth prospect as the other one, but the margin of safety should be higher, and that's the investment that you should be going with. Yep. The above may take a whole operation sound very precise. It isn't. Nevertheless, our business is that of ascertaining facts and then applying experience and the reason to such facts to reach expectations. Imprecise and emotional influenced as our attempts may be, that is what the business is all about. The results of many years of decision-making in securities will demonstrate how well you are doing on making such calculations. Whether you consciously realize you are making the calculations or not. I believe the investor operates in a distinct advantage when he is aware of what path is thought process is following. There is one thing of which I assure you: if good performance of the fund is ever a minor objective, any portfolio encompassing 100 stocks, whether the manager is handling 1,000 stocks or 1 billion stocks, it does not is not being operated logically. The addition of the 100th stock simply can't reduce the potential variance in portfolio performance sufficiently to compensate for the negative effect its inclusion has on the overall portfolio expectation. Anyone owning such numbers of securities after presumably studying their investment merit, and I don't care how prestigious their labels, is following what I call the Noah School of Investing. 2 of everything. Such investors should be piloting arcs. While Noah may have been acting in accord with certain time-tested biological principles, the investors may have left the track regarding mathematical principles. I only made it through plain geometry, but with one exception. I have carefully screened out the mathematics from our partnership. I didn't quite understand that. Did you get something out of that?
I mean, it's basically describing like an index, want to build 2 of everything and promise, above average and outstanding returns, and then say that you have studied everything. If you're saying you've studied everything and you're still buying everything, that doesn't kind of make sense.
Yeah, makes sense. Okay. Yeah. Of course, the fact that someone else is behaving illogically is owning 100 securities doesn't prove our case. While they may be wrong in over-diversifying, we have to affirmatively reason through a proper diversification policy in terms of our objectives. The optimum portfolio depends on the various expectations of choices available and the degree of variances in performance which is tolerable. The greater the number of selections, the less will be the average year-to-year variation in actual versus expected results. Also, the lower will be the expected results, assuming different choices have different expectations of performance. This is interesting. So, if I reread that sentence, it's kind of so the optimum portfolio depends on the various expectations of choices available and the degree of variance in performance which is tolerable. So maybe he's saying, he says it in the next sentence: the greater number of selections, the less will be the average year-to-year variation in actual versus expected results. So you should be concentrated more, is what he's saying. Am I reading that right?
Yeah, I mean, you have to figure out like what's more important to you, the variance or the outcome.
Yep.
So you can have a high number of selections that will reduce your variance, but it may hurt your results too.
Yep. Okay. I'm willing to give up quite a bit of terms of leveling of year-to-year results. Remember, when I talked of results, I'm talking of performance relative to the Dow in order to achieve better overall long-term performance. Simply stated, this means I'm willing to concentrate quite heavily in what I believe to be the best investment opportunities, recognizing very well that this may cause an unoccasional very sour year. Cause an occasional very sour year. One somewhat more sour probably than if I had diversified more. While this means our results will bounce around more, I think it also means that our long-term margin of superiority will be greater.
So he's willing to embrace volatility if that will give him overall better returns.
Yep.
He's not scared of volatility.
Yeah. Which is, I think, a lot of value investors now. They only have a concentration of maybe 7 at most stocks.
But as people who copy them, they may not be prepared psychologically for that.
Yeah, I agree. You have already seen some examples of this. Our margin versus the Dow has ranged from 2.4% in 1958 to 33 points in 1965. If you check this against the deviations of funds listed on page 3, you'll find our variations have a much wider amplitude. I could have operated in such manner as to reduce our amplitude, but I would have to reduce but I would also have reduced our overall performance somewhat, although it still would have substantially exceeded that of the investment companies. Looking back and continuing to think this problem through, I feel that if anything, I should have concentrated slightly more than I have in the past, hence the new ground rule and this long-winded explanation. Beautiful. Again, let me state that this is somewhat unconventional reasoning. This doesn't make it right or wrong. It does mean that you have to do your own thinking on it, and you may well have a different opinion. If you do, the partnership is not the place for you. We're obviously only going to 40% in very rare cases. This rarity, of course, is what makes it necessary that we concentrate so heavily when we see such an opportunity. We probably have only 5 or 6 situations in the 90 years of the partnership where we have exceeded 25%. Any such situations are going to have a promise very significantly superior performance relative to the Dow compared to the opportunities available at the time. They are also going to have to possess such superior relative and or qualitative factors that the chance of serious permanent loss is minimal. Anything can happen on a short-term quotational basis, which partially explains the greater risk of widened year-to-year variation results. In selecting the limit to which I will go in any one investment, I attempt to reduce a tiny figure to figure the probability that the single investment or group, if there is intercorrelation, can produce a result for our total portfolio that would be more than 10% points poorer than the Dow. We presently have 2 situations in the overall 25% category. One, a controlled company, and the other, large company where we will never take an active part. It is worth pointing out that our performance in 1965 was overwhelmingly the product of 5 investment situations. The 1965 gains, in some cases, there were also gains applicable to the same holding in prior years, from the situation ranging from about $800,000 to about $3.5 million. If you should take the overall performance of our 5 market general investments in 1965, the results are lackluster. I choose a very charitable objective. Interestingly enough, the literature of investment management is virtually devoid of materials relative to deductive calculations of optimal diversification. All texts counsel adequate diversification, but the ones who quantify adequate virtually never explain how they arrive at their conclusion. Hence, for our summation on over-diversification, we turn to that eminent academician Billy Rose, who says, we've got a harem of 70 girls and don't get to know any of them very well. Interesting. This is a pretty good quote. I mean, it's quoted widely in I guess, value investing gurus, where they say, look, we got to be more concentrated, otherwise we won't be getting the higher returns. So, yeah.
Yeah, I mean, I think it's basically saying that his biggest convictions are driving most of the gains.
Yeah.
And the smallest one, like in hindsight, he probably just wasted time putting any money in them.
Yeah. 25% is a crazy amount, but yeah. Miscellaneous. Lastly, last year we boldly announced an expansion move encompassing an additional 227.5 square feet. Older partners shook their heads. I feel that our gain from operations from 1965 of 12 million indices that we did not over-exceed ourselves. Fortunately, we didn't assign a percentage lease. Operationally, things have been running very smoothly, and I think our present setup. I lost my. Present setup unquestionably lets me devote a higher percentage of my time to thinking about the investment process than virtually anyone else in the money management business. This, of course, is the result of really outstanding personnel and corporate partners. John Harding has taken complete charge of all administrative operations with similar results. Bill Scott continues to develop detailed information on investments, which substantially enhance our net profit figure. Beth Feehan, Donna Walter, Elizabeth Herron, who joined us in November, have all handled large workloads. Secretary note, amen. Accurately and efficiently. The above people, their spouses, one apiece, and children have combined investments in the partnership of over 600,000. Susie and I have investments of 6 million, 7 million, close to 6.8 million, which should keep me from slipping away to the movies in the afternoon. This represents virtually our entire net worth, with the exception of our continued holding of Mid-Continent Tab card. I guess that's like Sam's card at the time. A local company which I bought in 1960, which when it had less than 10 stockholders. Okay, this is separate. Interesting. Additionally, my relatives, consisting of 3 children, 2 sisters, brother-in-law, father-in-law, 3 aunts, uncles, blah, 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 have directly totaling 2.7 million, so they don't get any ideas of voting a chance in the partnership name. Pete Mitchell and Co. have done a customary excellent job of expediting our audit. Blah 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 blah. I was worried that someone else would become our general partner. However, it's all worked out quite smoothly. Within 2 weeks, you'll get a letter, and we have the audit, so you'll get that. Okay, nothing really there. Number 3, a signed letter from me. Okay, let me know if anything else is missing. Clarify that needs clarification. It's difficult to anticipate all these questions that you may have, and if there's anything that's confusing, I want to hear from it. For instance, we received an excellent suggestion last year from a partnership regarding the presentation of the reconciliation of personal capital accounts. My next year will be about July 15th, summarizing the first half of this year. Virtually, Warren E. Buffett. Exciting.
Oh, that was a good letter.
That was a great letter. Yeah, I really enjoyed that. I think that was great.
All right, to our next letter, which will be 1966, Buffett partnership letters. We only have, till 1970 before he dissolves the whole thing and just focus on Berkshire.
Yep.
So let's see what other nuggets we can get out of it.
Exciting times. All right, till next time.